Make sure you check for these 7 things before you enter a trade so that you can become a profitable trader in the long term. I've been trading for over 10 years and this took many years, many losses for me to really learn my lesson. So before I get into the first point, this video is sponsored by Blueberry Markets, and if you are looking for a reliable broker to trade with, I'll put the link in the description below so you can sign up with them. Now these steps are all in sequence, so follow them step by step and don't skip any step. The bonus tip at the end is the most important thing. Otherwise, whatever that I'm talking about today is not going to work out, okay? So the first thing that is very important, there are literally books written about just this one subject, and it's also the same reason why a lot of institutions nowadays, they hire athletes. Before you make your first trade, you need to be emotionally stable. And a lot of athletes are very disciplined because a lot of times when we don't want to train, we have to train. Before you make your first trade, you're gonna make sure that on that day itself, you did not fight with your husband or wife. The sadder you are, the more likely you're going to buy things you don't need, and in this case, buy or trade stocks or currencies that you're not supposed to trade. So on those days when I'm sad, angry, I just don't trade. I just don't look at the charts. I just do something else that would help me become a better trader without trading, and that is reading a lot of books. And also back testing the charts. Basically just scrolling back to the historical charts and then just see what happened on that day and then learn from that. You can learn so much from just studying history alone. And also another very important thing is when you're sitting down on your trading desk, make sure that you did not just came out of Instagram where a lot of people were like, I just bought a mention with Forex starting with $1,000, like how I flipped $100 to $10,000 within 1 week by not managing your risk. When you saw that on social media, Instagram, Facebook, TikTok, and you sit down on your trading desk and you be like, I'm only generating 4%, 5% a month, and these people are generating 100% per month, you're probably gonna do the same thing if you're not disciplined enough. And if you're not disciplined enough, either go run a freaking marathon or go and read this book. Now, second thing you gotta check whether you're a day trader or a long-term trader. For long-term traders especially, this is your secret weapon, and that is fundamental analysis. So I come from a finance background and I've been speaking in a lot of institutional traders events these past 2 to 3 years, and I find that a lot of hedge fund traders, in fact, the top hedge fund managers in the world, they trade long-term. They look at global macro factors to make their trading decisions, especially for somebody like George Soros. Do you think that he look at a freaking indicator and then be like, RSI is oversold, now let me sell? Paul Tudor Jones, George Soros, they all look at macroeconomic factors or macro factors to make their trading decisions. Interest rates, economic indicators, to make those trades that generated them millions, billions of dollars. So one of the most important things which I've taught on this channel is sentiment analysis. There are many different ways that you can check for sentiment, and the first, most simple way is to look at the stock market. So if the stock market is rallying at this point in time, it is going on an uptrend, then it tells you that the sentiment is positive, people are optimistic. Another alternative way is to look at the volatility index. In short, VIX. So basically, if VIX is very high, it tells you that people are very scared, and if VIX is low, below average, then it tells you that people are being complacent. And one thing I talk a lot in this channel is that VIX tends to respect support and resistance zones very often and ranges very often. And when it does test a major support resistance zone, that is when you need to take note as well, because all these are going to affect things like the stock market, bond market, currency markets, commodities market. And then this comes down to inter-market analysis, because nowadays markets are interlinked because of electronification of trading. Markets are getting more and more connected to each other, and a lot of us in Singapore, Asia, we have access to the US markets, UK markets, and hence because of the globalization of trading, that's why markets nowadays are more interconnected than ever. And yet a lot of retail traders nowadays, they still focus on what? Technical analysis. There's a time and place for that, but if you want to trade like the professional hedge fund traders, you gotta look at what they look at, which is intermarket analysis, sentiment analysis, fundamental analysis. Not to trade or scalp the news, because I don't scalp the news. That's a different thing altogether. we look at economic indicators to determine the long-term direction of that certain market. So what you can do for intermarket analysis is use that to confirm the trend, to increase the probability of your trade. So let's say, for example, if you're trading Canadian yen and you're looking for a buy trade, you want oil prices to be on an uptrend. Gold is a little bit different as compared to the risk markets like oil because it's driven by its specific set of factors. Because gold in itself, it is a safe haven market, but at the same time, it is also tied to the Australian dollar. Then if you're a stock trader, stock investor, you gotta look at the earnings report, look at economic indicators because it's going to affect the stock that you're trading or investing in. So then this comes to the next step, which is you need to look at the bigger picture, because no matter how good a stock or currency is, if everything in the bigger picture is dragging that stock down, then that good stock is still going to go down. So for example, if you're looking to buy and trade a stock today, okay? But then if the S&P 500 DJIA is going on a very strong downtrend, then you wouldn't want to buy, because if all the major indexes are contradicting the stock that you want to buy, then it's going to decrease the probability of your trade. So you want all these major indexes to be on an uptrend when you're looking to buy a stock. But also at the same time, when it comes to the individual currency or stock, you gotta look at the bigger time frame. So for example, if you normally enter in H1 for Euro USD, then you need to go to H4 and then D1 to check and make sure that the currency is on a very strong uptrend. If it is going sideways, going down, then it's going to decrease the probability of your buy trade. So what I do a lot of times is that when I'm backtesting, let's say if I'm looking at H1 to enter, I'll put a vertical line right there so that I know that when I switch to H4, okay, this is the particular candle which we are analyzing and observing right now. So of course, visually you can tell whether a currency or stock is on an uptrend, downtrend, but sometimes when you're not so certain, you can use moving averages. So what you can do is that you can put a 100 SMA and then followed by a 200 SMA when the currency is on a very strong uptrend. Then you will see these two moving averages sloping up and the 100 SMA will be above 200 SMA. Then when it comes to downtrend, it will be the other way around. These two moving averages have to be sloping down ideally, and then the 100 SMA has to be below 200 SMA. And when it starts crossing over each other, it might be a false signal, but also it might be a sign that the trend is going to end or has ended, because moving average is still a lagging indicator. When all these criteria are fulfilled, then you go on to the next step, which is to look at supply and demand zones and also support resistance zones. So when you're looking for a buy trade, ideally you want to enter on a confluence. So let's say if you have a support and resistance zone where the price is testing at, and at the same time it is also testing your moving averages, which will act as a dynamic support. Or if there's a very strong demand zone, then it's going to increase the probability of your trade. So how do you find supply and demand zone? First step is to look for a very strong breakout downwards for a supply zone or a very strong breakout upwards for a demand zone. So that's the first step. And then the second step, make sure that the volatility before the breakout is very low, meaning that you see very small candles, no large candles, and the consolidation only lasted for a while, only for a couple of candles. It cannot be like 10-20 candles because that's too long. And the third step, you gotta make sure that this supply and demand zone has not been tested for more than 2 times. Okay, 2 times. Ideally, it hasn't been tested before. And then the fourth step you gotta do, just sit back and wait for the price to enter the zone. But doesn't mean that when it enters the zone, then you enter immediately, because you gotta follow the next few steps. And the next thing you need to check, okay? This is very important as well because it's gonna affect the amount of money you make, and that is the cost of trading. So because the brokerage industry is so competitive nowadays, everybody wants to offer low spread, but that doesn't mean that if there's low spread then it's a good broker, because a lot of times this is just what brokers do to entice people to sign up for a new account. So if you're looking for a reliable broker, you can consider Blueberry Markets, and they are regulated by the Australian Securities Investment Commission, and they have very good customer service, and you can trade with what you already know, which is MetaTrader 4, MetaTrader 5. And when you trade with Blueberry Markets, you'll get a credit bonus where you receive trade credit amounting to 20% of your original deposit. And when it comes to withdrawal, no problem so far. I've been able to get my money, capital back. Then comes the sixth step, you gotta check the risk to reward ratio. So the problem with a lot of retail traders is this. Every time they see something that other people are buying, they only look at, oh, they are earning so much money. You can earn $1,000 a day from this weird crypto that nobody even heard about. There's a new stock in town that everybody is talking about. You know, you can earn like 100% a day, you know. They sit on their trading desk and then they think about how much money can I make in this trade. Now, there's nothing wrong with that because it's good to focus on earning money, but to become a successful trader, the top traders in the world, every time before they open a trade, they always ask themselves, how much am I risking? So let's say if this trade has a potential to earn me $200, but then I'm risking $1,000, my whole entire account, to earn this $200. Is it even worth it? Basically, think of the risk to reward ratio. This is so important to put in simple terms, okay? Like if you're a freaking robber today, if you're a robber, okay, and you go into a store to steal a makeup organizer, okay, that is worth like $20. But then you get caught and then you get fined $2,000 for stealing something, and then you gotta go to jail for like 6 months. Is doing this even worth the amount that I'm risking? Always think in terms of that. Every time when I talk to hedge fund managers, all they think about is alpha. How do I generate alpha while minimizing beta, meaning the volatility, the risk? And when you ask the top traders in the world, they always say that I'm a risk manager first, trader second. Whereas when you ask those retail traders or those trading gurus with no finance background, they just come out and teach after Googling. All they think about is, how can I flip $50 to $2,000 in one day? Of course, once in a blue moon, once in a blue moon, you will come across stocks that provides you with super good opportunities to generate fast returns within a short amount of time. Yes, it is possible, but the problem with social media nowadays, I see way too many people flipping accounts while risking everything. And of course, one more bonus tip is make sure that you're not risking more than you should risk. So for example, if your risk appetite is conservative, then you should risk 1 to 2% per trade. If you're risking anything more than that, then you're gonna recalculate your lot size. And not just in the context of individual trades, but also your overall portfolio. So let's say if you already have open trades in your whole entire portfolio, you have a couple of stocks, you have a couple of currencies, and then when you want to open this extra trade right now, how much risk is it adding to your overall portfolio? Because if all the open trades that you have are all correlated to each other, you're going to massively increase the risk of your overall portfolio. If it's a trade to hedge the other positions, then it's going to decrease the risk of your overall portfolio. So you gotta take that into account too. If you don't understand anything about price action, confirmation, then you can check out this video where I explain more in detail. Okay, so with that, talk to you in the next video. Bye.